How to minimize taxes on your retirement withdrawals. Most people are about to throw away six figures in taxes they don't have to pay. You're working your entire life to build wealth, and then the IRS shows up to claim what could be 30, 40, even 50% of your retirement withdrawals. But here's what nobody tells you. There's a legal playbook that can cut that number in half. Stay with me because by the end of this video, you'll know exactly how to keep more of the money you earned. Let's start with why this matters so much. You're 55 years old. You've got $1 million saved across your 401k, your Roth IRA, and a taxable brokerage account. You want to retire. The problem? Every dollar you pull out gets taxed as income. Depending on how much you withdraw, you could be paying 22%, 24%, or even 37% in federal taxes alone. Add state taxes in California or New York and you're looking at 50% of your withdrawal disappearing. That's not a retirement plan. That's a disaster. The solution is what I call tax bracket stacking, and it requires understanding three accounts that most people treat the same way. They're not. Part 1. The power of the Roth. The Roth IRA is the closest thing to a retirement cheat code. You've heard that before, but here's why. Withdrawals are completely tax-free. Not taxed at a lower rate. Not deferred. Completely eliminated. That means if you put $7,000 into a Roth IRA at age 30 and it grows to $70,000 by age 60, you pull out all $70,000 and the government sees zero. The growth is yours. Compare that to a traditional 401k where every single dollar you withdraw is taxed as ordinary income. Let's say you have $500,000 in a traditional 401k and $200,000 in a Roth IRA. If you need $60,000 a year to live, most people would pull $60,000 from their 401k and pay taxes on that full amount. Wrong move. You pull $30,000 from your Roth and $30,000 from your 401k. Your taxable income is lower. Your tax bracket stays lower. And you're strategically paying zero taxes on half your withdrawal. But here's the thing. Most people don't have enough in their Roth because they started late or didn't understand the math. If that's you, we fix it now with what's called a backdoor Roth conversion. You contribute to a traditional IRA and immediately convert it to a Roth. Yes. It's legal. Yes. The IRS allows it. You'll pay taxes on the conversion, but you're paying them on your terms. In years when your income is lower. Not forced withdrawals at age 75 when you're required to take money whether you need it or not. Part 2. The tax loss harvesting secret. Your taxable brokerage account is a weapon most people waste. Here's how to use it right. When you own individual stocks or index funds outside of retirement accounts, you have control over when you sell them and trigger capital gains taxes. Let's say you bought Vanguard S&P 500 index funds for $100,000 5 years ago. They're now worth $150,000. If you sell them all at once, you're paying 15% long-term capital gains tax on that $50,000 profit. That's $7,500 in taxes due that year. But if you sell them across 3 years, pulling $50,000 each year, you might only pay taxes on $15,000 in gains per year. The tax bill drops. Or, and this is the smart move, you hold the winners and sell the losers to offset gains. If you've got a losing position in your taxable account, sell it, realize the loss, then buy a similar fund to stay invested. You've reduced your taxable income without actually reducing your market exposure. That's tax loss harvesting and it can save you thousands annually. Part 3. Sequencing your withdrawals. Here's the framework. In early retirement, before Social Security and before required minimum distributions start at 73, you're in control. Pull strategically. Year 1. Take $40,000 from your taxable brokerage. Year 2. Take $30,000 from your traditional 401k and $20,000 from your Roth. Year 3. Pull primarily from your Roth since you've already paid taxes on conversions. The goal is simple. Keep yourself in the 12% tax bracket or below for as long as possible. For 2024, that's roughly $47,000 of taxable income for a single filer. 1 year below that threshold is worth tens of thousands of dollars over a 30-year retirement. This is not complicated math. It's not risky. It's not some loophole that'll get you audited. It's the system working exactly as designed for people smart enough to plan. If you're serious about actually keeping the money you earned, subscribe right now. We're dropping videos every week on tax strategies, withdrawal tactics, and everything between here and financial independence. Click subscribe and hit that notification bell. Your future self will thank you.